Hey, good morning, everyone. This is Chris Verrone, Head of Technical and Macro Research at Strategas, the investment strategy arm of Baird. Thank you, as always, for joining us. Certainly a lot to talk about this morning. Where we want to begin, though, is really reiterating what we've written in our client notes this week. It's been our experience that geopolitical conflicts or exogenous events really do more to reinforce the trends that are already in place rather than act as a catalyst for some big change. I think that's been on display again over the last several days. For example, gold was very strong coming into this. It remains so. We continue to like it long. The triple Qs and the large cap growth stocks have really been pronounced underperformers for the better part of the last 3 or 4 months. That has continued here. We've seen oil, which has been in a bull market now, really for the better part of the last year. That has accelerated over recent days. Discretionary has been weakening for the last 6 months. That continues over recent days. A lot of the speculative corners of the market, which have been the weakest part really of this market for the better part of the last year, they remain laggards here as well. So, we look at this crisis through the lens of the trends that are already in place, and I think the market has done more to exaggerate those or reestablish those than change anything meaningful. As far as some big themes in our work, the number one thing we've been talking about for the last several months is this idea of regime change. Everywhere we look, we see the market really giving us different signals than what we've experienced over the 12 or 13 QE, the 12 or 13 year QE regime that we've been in. I think principal among them when we talk about equities, this is the first equity market correction in 13 years where bond yields have gone up, not down. That is a major change. Similarly, this is the first equity market correction in the QE era where the energy sector has actually outperformed. That is a major change in character. And conversely, it's really one of the first corrections where the large cap growths and the FANG stocks have not proved defensive. They've been what have led on the downside. So we include this list here. These are 13 changes in our work that look different than the last 13 years of this QE regime. I think it's a very good starting off point for how we see this theme of regime change underway. Principal among them has been this idea that value is taking share relative to growth. I don't think this is a new idea. This is something that's been a focus of our work over the last year. It's only been accelerated over recent months, both up and down the cap scale. This blue line is small cap value relative to small cap growth. That is decisively broken out here. And the red line, the big turn we see is large cap value versus large cap growth. I do think the rate environment is continuing to drive this story. I mean, even today, despite the Ukraine-Russia news, bond yields really aren't down that much. Bonds are not serving as much of a hedge to equities right now. And that's what we show you here. Of these 1, 2, 3, 4, 5, 6 major equity corrections in the QE regime, in every single one of them, bond yields went meaningfully lower. Clearly, this experience has been a change. And when we see big changes like this, we pay attention. Equities are not providing a hedge to bonds. We also see it, this character change with how the energy sector has responded here. Energy is outperforming even as the market corrects. First time that we've seen that in this 13-year QE regime where energy has actually proved defensive. My colleague Todd Sohn did some good work this week just looking at energy's historical weighting in the S&P 500. I think many forget in the early 80s, energy was really the technology sector of the S&P with a weighting of about 27% of the index. That fell to as low as 2% in late 2020. We're up to, let's call it close to 4% today. The 40-year mean is something like 11%. So we think there's continued room here for energy to mean revert. I recognize there might be a war premium in some of these stocks. They may be overbought in the short term, but when we look at the structure, when we look at the sector structurally, we do believe there is a continued value here over time. As far as the equity market goes, what we're still looking for is something more capitulative from the options market to mark a good short-term low. Put-call ratios are a good place to look for that. Basically, every major equity bottom over the last 6 or 7 years, we have seen a very pronounced spike in put-call ratios. We certainly saw that in the waning days of the COVID crisis in late March of 2020. We have yet to see that today. So we'll watch for this over coming days. I do think the broader package of sentiment data is starting to get more constructive. This is the weekly II bull-bear ratio. We're not quite at an extreme there, but we are approaching the 10th percentile historically. So a change in attitude is certainly welcome. And if you just look historically at cyclical bear markets, so these are all bear markets since 1950, excluding the down 50 events of 2000 through 2002 and 2007 through 2008, you're basically looking at 20% events. S&P down about 14 or 15 thus far. So in the context of a cyclical bear, down 20 to 22 has typically been what you've seen. It's taken about 6 months to get there, and then about another 8 months to reclaim the prior high. So we'll use this as some type of a framework going forward, but tactically watch the put call data, watch the sentiment data to get a sense of when fear is being introduced into the options market. Maybe the biggest theme in our work has been this idea of owning the average stock over the top of the market. So we look at that by basically illustrating the equally weighted S&P outperforming the FANG stocks. This has been a major turn. Again, I think it speaks to what we've seen in the bond market. I think it speaks to what we've seen value versus growth. Average stock over the top of the market is a pair that continues to pay. I think the other big story from a sector perspective we want to just be mindful of is the continued underperformance from consumer discretionary. Discretionary peaked relative to the market, let's call it 4 or 5 months ago. It's been deteriorating throughout this period. I think that's only exacerbated here as crude oil makes its march towards $100. It's tempting to look at the underperformance of discretionary and come to a recessionary conclusion. We get that. I think the missing piece, though, is the financials, which have largely still held up okay here. Financials have moved with long rates. That's unusual for big market tops. You tend to see financials actually start to diverge and weaken before the bond yields peak. That was the case in 2018. Bond yields peaked in November of 18. Financials rolled over roughly 6 months before that. So we'll continue to watch financials here for signal. And then lastly, as we talked about at the top, we remain impressed with gold. I don't think the flows are terribly aggressive yet. Gold has broken out through 1900. This is really the only hedge that is working. Bitcoin has certainly failed its test as a hedge. Bonds, as we talked about, not providing much of a hedge to equities. Gold is filling that void here. So a lot going on in the world. I think the most important themes in our work are geopolitical conflicts really rarely change trends. They tend to reinforce them. I think second, this idea of regime change, whether it's bonds not as a hedge for stocks or energy outperforming in this crisis, I think is notable. And then lastly, watch the financials for some type of a leadership signal here. That's what we have. As always, thank you for your time. Look forward to talking to you soon.